Hello, everyone, and welcome to part 4 of 5 of my personal finance for recent graduates. This time we will be going into investments. First, I'm going to start by defining investing. Investing is putting your money into assets such as stocks or bonds with the expectation that your money will grow in the future. There are many different types of investments out in the investment world, but this presentation is kind of going to focus on the main ones, which are stocks, mutual funds, exchange traded funds or ETFs, index funds, and bonds. The first type of investment I'll be going into is stocks. Stocks are an investment in a specific company like Target, Microsoft, Apple, pretty much any publicly traded company that you can think about, you can buy a stock in. These companies sell their shares to raise cash for business use. You buying a share is equal to buying a piece of the company's earnings and assets. And if it goes up, you will earn money. If it goes down, their earnings and assets, then you will lose money. Some of these stocks will pay out dividends on a semi-annual or an annual basis, and that is kind of them sharing the wealth, sending out equal amount to each investor to help their earnings for the year. Stocks are typically higher risk than other kinds of investments because you are investing in only one company. That is why it's best to choose wisely when you pick which company you would like to support, because if they have a really bad year, it could make your investment go down a lot very quickly. The second type of investment I'll be talking about is mutual funds. Mutual funds are a large number of investments in one transaction. They pool investors' money and they hire professionals to pick which investments go into each mutual fund. Each mutual fund follows a set strategy, like they follow a certain industry, they have only tech stocks. You can kind of choose which one fits for you. The risk depends on which fund you purchase. If it's all big tech stocks, it's going to be more risky. If it's something more along the lines of utilities, it's going to be a little bit less risky. They can have stocks or bonds in them. They distribute portions of their earnings to investors, and with these comes an annual fee called the expense ratio to pay those professionals that pick the investments to put in these mutual funds. And these are typically priced once per day instead of all day that the market is open like individual stocks would be. The next type of investment is an exchange traded fund or an ETF. This is a type of pooled investment that operates like a mutual fund, so it has many different stocks or bonds in it, but it is traded on exchange like a stock, so it is priced throughout the day. The price fluctuates instead of being only priced once per day like a mutual fund. Most of these are not actively managed by a professional, so they have much lower fees and could cost less than buying individual stocks and all the fees that come with buying that. You can buy a bunch of them in a pooled investment type like this. The next type of investment is an index fund, and this is a type of mutual fund or ETF that tracks an index. For example, the S&P 500, the NASDAQ. These are not actively managed. They earn dividends or interest, and they distribute those to the investors. You can sell them for a profit just like stocks, and the charges on these are expense ratios, but they're usually lower than other mutual funds or ETFs because they are just tracking an index and do not need professional managers to switch out what investments are in there. The next type of investment is bonds. Bonds are a loan made to a company or the government. They are a fixed income investment. They're less risky than stocks, but they do have lower returns because of this. The primary risk with bonds is that the issuer defaults. U.S. bonds are backed by the full faith and credit of the government, however, so the risk of default is very low if you are buying those kinds of bonds. They pay interest to you for loaning your money to them, and that interest usually comes once or twice a year. And then at the end of however long your bond term is, your principal or the amount you gave them is paid back to you at what is called the maturity date. Now that I've gone over those basic 5 investment types, I'm going to talk a little bit about building a balanced portfolio. So as an investor, you don't want to have only stocks or only bonds because of how the market acts. It's constantly going up and down, and different investments are better for different times of the market cycle. And having a balanced portfolio will reduce your risk and just increase the diversification of the investment types that you have. So with building a balanced portfolio in mind, I just want to stress the importance of financial advisors. These are professionals out in the field. They're highly intelligent on market concepts. They have access to knowledge that outside investors may not have access to. They will sometimes have portfolios that are pre-built and are already working with existing clients. They have different types of reporting that they have to do, keep up with certain guidelines from FINRA, and they have ways of reporting that knowledge to you also. And they're also just there to help you reach your goals. So if investments kind of stress you out, I would suggest finding a financial advisor someday, and it will take some of that stress away. And that concludes our lesson on investments. The next lesson, part 5 of 5 of my personal finance for recent graduates, will be making a budget now that we have all of this knowledge.